This is an asset class which really needs, in our view, to be represented in everybody's portfolios, largely on the basis that as growth becomes increasingly difficult to find in the developed world, investors will start to look overseas to those areas where growth is more readily available. And emerging markets really top the bill of those places where growth is likely to be found. Now, if you go back 15 to 20 years, this was an area of investment which was fraught with danger for investors. Often there were restrictions which prevented foreigners from making investments in countries. Often there were terrible corporate governance problems, enormous volatility, and we staggered from crisis to crisis. I counted at one point during the 1990s something like 27 financial crises in emerging markets. Since 1998, however, the picture has changed rather radically. In 1998, emerging markets went through something akin to what we are seeing in the developed world post-2008. They had a financial crisis and they stared into the abyss. A number of countries indeed did go bust. But that did focus people's minds, and the balance sheet clear out, the deleveraging process, the improvement in finances at both governmental, corporate and personal levels started to come through post-1998. And when the bull market took off in 2003, emerging markets participated fully in that. And they started off at levels of valuation which were very low. So we had strong balance sheets, we had lots of growth, and we had low valuations. It was a very attractive mix of influences which led to emerging markets doing extremely well over an extended number of years. We then went into the financial crisis, and although in the financial crisis emerging markets suffered, stock markets suffered in much the same way as developed stock markets suffered, the underlying damage to the companies and to the government balance sheets was far less than we saw in the developed world. And therefore in the recovery, starting in March 2009, emerging markets were able to rebound very happily, very spectacularly in fact. And we saw something develop which we haven't seen before, a divergence really in favour of the emerging markets over the developed markets. And that was because financial strength was greater, growth was more obvious, and valuations at that stage were very low. Since then, we've had a good run in these markets. It ran out of steam somewhat in the autumn or the fall of 2010, and over the last 6 months or so not very much has happened. We've had some crises in some parts of the emerging universe, for example in the Middle East, but on the whole the underlying economic fundamentals of these countries remains extremely robust. Just think China or Brazil or India. The stock markets, the companies in the stock markets are much stronger and more diverse in availability than they were 10 years ago. So we can invest in anything from Brazilian rental car companies to retailers in China to manufacturers of shoes. All sorts of things are available to investors now which weren't available before. And we also see a much more normal economic cycle than we're experiencing ourselves. And that means that in the emerging world we've seen some inflation develop, but instead of worrying about whether interest rates can be raised or not because of the underlying weaknesses in these economies, monetary authorities in most of the markets that we look at in the emerging world have started to raise interest rates in order to take a little bit of heat out of the economy. And that's really been the headwind that stopped markets in their tracks. We think that valuation, with earnings growth in the mid-teens that we're seeing looking forward for this year and for next year, valuation is beginning to come down to attractive levels again. And this begins to be an opportunity, with this enormous strength that emerging markets are showing, for investors to start to put a toe in this water.